So dear students, so welcome to session number 1 in financial analysis paper of BBA program of Mangalore University. So basically in this course, we will discuss about the concept of financial statements, its meaning, the types. Then we will go for financial statement analysis. The various analysis we will be discussing in the coming chapters or the modules. It may be the comparative analysis, common size, trend, cash flow, fund flow, ratio analysis. Then we will be discussing about leverage analysis, and finally we will be focusing on creation of wealth, which includes economic value added and market value added. So this is a blueprint of this particular course. Now in this session, a very important concept, that is financial statements, we will be discussing. Now basically the overview of the financial statements. If you go back through year 1929, the time stock market crash was happened in US. The United States experienced great economic depression, and after that the US Congress passed the law with respect to preparation of the financial statements every quarter with respect to the corporates. So every quarterly they have to prepare their financial statement and they have to present to the public. So this is the background of the financial statements. Now first, in this session we will be focusing on 3 areas. We will cover meaning, the types of financial statements, and finally the nature of financial statement as well as the characteristics. Now as we know that as an investor or as a owner or as a stakeholder of a business concern, so they want to know whether the company's financial position or the financial performance, so the reliable data they need, and that is financial statement. So financial statement are a mirror that shows a true and fair view of the financial performance of the organization, and it serves as a means of communicating the information about the profitability as well as the financial position. So profitability and financial position will be covered in the 2 main financial statements, that is profit and loss account or income statement as well as the balance sheet. So in a concise and understandable manner at the end of the accounting period. So ultimately financial statement means communication of the profitability or performance of the organization in a very concise and understandable manner at the end of the accounting period. So it's also called as financial reports. It's also called as financial reports. Now, definition part, in the word of Anthony, financial statements essentially are interim reports presented annually and reflect a division of the life of an enterprise into more or less arbitrary accounting period, more frequently a year. So very clearly he presented. So annually the reports are prepared focusing on the profitability and how much the company is having, assets, liabilities, equity, reserve fund. So all these things are very important for different stakeholders. So that we'll be discussing in the next point. So financial statements are used by different stakeholders. So now here stakeholder means stakeholders. ನಾವು ಯಾರನ್ನು ಕರಿತೇವೆ ಅಂದ್ರೆ ಇಲ್ಲಿ those who are directly or indirectly connected with the organizational performance. So stakeholders includes like internal and external stakeholders. ಸೊ ಅಲ್ಲಿ ಶೇರ್ ಹೋಲ್ಡರ್ಸ್ ಆಗಿರ್ಬೋದು, ಅಂದ್ರೆ ಓನರ್ಸ್ ಆಗಿರ್ತಾರೆ, ಅಲ್ಲಿ ಮ್ಯಾನೇಜ್ಮೆಂಟ್ ಆಗಿರ್ಬೋದು, ಎಂಪ್ಲಾಯೀಸ್ ಆಗಿರ್ಬೋದು. ಅದೇ ರೀತಿ ಎಕ್ಸ್ಟರ್ನಲ್ ಸ್ಟೇಕ್ ಹೋಲ್ಡರ್ಸ್ ಅಂದ್ರೆ ಕಸ್ಟಮರ್ಸ್, ಇನ್ವೆಸ್ಟರ್ಸ್, the suppliers, maybe the creditors, stock exchange, the government authorities, and general public. So ultimately these are the stakeholders, or these are the users, we can say. So these people are constantly observing the financial statements of the company. So owners, they need the financial statement to analyze the performance of the company. Management need that financial statement to review the performance and to take decision for the development or growth or diversification. Next, as an investor, if you want to invest in the company or you have to make choose of any company, preferably you go for their profit and loss account, income statement, or balance sheet. So over a period of time, you will come to know the consistent performance of the company. So basically, with respect to the types of financial statement, so we're having broad 4 categories of financial statement. The first one is income statement, balance sheet. Second one, so income statement is actually a product of a trading account and profit and loss account. The balance sheet is also known as a statement of financial position. Position statement, like that we are calling. The third one is the statement of cash flows. And the fourth one is a statement of the changes in equity. So basically the 4 types of financial statement we are covering. So this is the nutshell information. Now the statement of financial position will focus on assets, liabilities, and the capital. So usually we know the equation with respect to assets. Asset equivalent to liabilities plus capital. The resources owned by the organization, and the liability means the debt or the owed amount, and finally the capital. Then the profit and loss statement will give you the figure of net income or maybe the net loss of the current year, and the cash flow statement will give you the net cash flow of the business, and finally the changes in equity statement will focus on the dividend, the share issued, and the profit changes. So one by one in brief we will cover. And as per the statute, as per the Indian companies requirement, so the financial statement will include the following types. So the director reports will come there. He will present at the time of the AGM. Auditors reports, profit and loss account, balance sheet, and finally the notes forming part of profit and loss account and balance sheet. So when you prepare the final accounts as per the revised format in a vertical format, so final accounts will be prepared with the notes. So notes are actually a supportive document for the profit and loss account and balance sheet. But here our focus is only on the first four fundamental financial statement. The first one is the income statement. So income statement will focus on the three major components, that is the revenue, profit or loss, and expenses incurred during the year. So income statement ultimately will give a clear picture about the profitability of the organization. So we'll prepare that trading account and profit and loss account actually. So based on that, the income statement will be prepared. So the format of the statement of profit and loss account is specified in part 2, schedule 3 of the Companies Act of 2013. So this is the specimen of or the pro forma of the statement of the profit and loss. So usually we'll start with the revenue from the operation. It's like a sales. Next we will add the other income. So we will get the total revenue less all expenses. It may be the purchases or the volume change in inventory or employee benefits and expenses like salary, wages, financial cost or finance cost like interest on debentures, depreciation, and finally the other expenses. Like all other expenses will come here, office, selling overheads, all these things. So corresponding note number will be there. And finally, when we will subtract the total expenses from the total revenue, so we will get profit before tax less tax paid. So the end figure will be profit after tax. So this is the format of the income statement. Then second type is balance sheet, very important financial statement. So it will give a true picture about the financial aspect of the company. So usually it is prepared after the final account. So balance sheet is also known as a statement of financial position, where you will get clear picture about the assets, liabilities, and equity at the end of the accounting period. So the net worth of the business, that the equity you will get by deducting the liabilities from the asset. And as per the Companies Act, the Schedule 3 guidelines are given. In Schedule 3, guidelines are given with respect to the preparation of the balance sheet. So this is the pro forma of the balance sheet. So here bifurcation, like we are having equities and liabilities. So note number 1. Next we are having non-current liabilities like long-term borrowings or any long-term liabilities we are considering. Next, current liabilities. And coming to asset side, now we are calling as non-current assets, where we are having fixed assets, tangible, intangible. Then intangible assets under the development, it's like a non-current investment. Next we are having current assets. Next, other current asset like miscellaneous expenditure we are calling. So this is a pro forma of the balance sheet. The third type is cash flow statement or statement of cash flow. So usually in the income statement, we will not get any clear picture about cash flow of the organization. So that's why the separate statement is prepared with respect to cash flow. So here the inflow and outflow of cash will be determined under three heads: operating activities, investing activities, and financing activities. And finally, we will get the net cash flow of the business concern. And the last one is statement of changes in equity. So this type of financial statement shows the contribution of the shareholders, means the shareholders contribution, the promoters equity, and maybe the FIIs or mutual funds. So ultimately we'll get picture about the equity position in the organization and the movement of equity and the balance of equity at the end of the accounting period. So it shows also the changes in equity that take place during the accounting period, where any other new issues are made or issuing of any dividends, bonus shares, right issue. So all these things we will come to know in this particular statement of changes in equity. So the first four financial statement are income statement, balance sheet, and statement of cash flow, and finally the statement of changes in equity. Now the final part of this particular session, where we'll be focusing on nature or the characteristics of financial statements. So as per the American Institute of the Certified Public Accountants, they stated the nature of financial statements. So financial statements are prepared for the purpose of presenting a periodical review of report on progress by the management and deals with the status of the investment in the business and the results achieved during the period under review. So basically they reflect a combination of the recorded facts, accounting principles, personal judgments, as well as some kind of assumptions here. So based on this particular definition, so the four very important nature of financial statements are recorded facts, means financial statements are historical in nature. Historical data is based on the recorded facts. Second one, it is based on some accounting principles and conventions. And finally, it is based on some, or we can say that, personal judgments or maybe some kind of assumptions. So one by one we will discuss. The first one is the recorded facts. Now usually the financial statements are prepared uh, based on some final accounts. So where usually we will focus on the accounting cycle. Accounting cycle is nothing but first we will prepare the journal entries. After that we will go for ledger accounts and subsidiary book, and finally we will go for trial balance actually. So based on that we will go for trading account, profit and loss account, and balance sheet. So all the business transactions which are having the financial character, only those are recorded in the books of accounts, and based on that the financial statements are prepared. So the data drawn from accounting records only considered here, and the financial statement are not prepared on the basis of the market price or maybe realization value. And basically the financial statements are historical in nature, means it's based on the historical data. Second one, accounting conventions. Now basically when you will prepare the final accounts of the company, and based on that you will go for preparation of the financial statements. So both are based on certain accounting principles and accounting conventions. So the four fundamental accounting conventions are there. Maybe convention of conservatism, convention of consistency, or convention of full disclosure, and finally the convention of materiality. So based on these accounting principles and accounting conventions, the financial statements are prepared. And there should be a consistency in the principles, consistency in the system. The third one is postulates. Means there are some assumptions are made, just like accounting concept and convention, while preparing the financial statements. So in accounting concept, we are having that going concern concept, money measurement concept, or realization assumptions we are making. The same assumption we are also following in preparation of the financial statements. So we assume that company is a going concern. There is no end for the company. And we are having that separate entity concept, separate legal entity concept. Ownership and management is different in the company. And finally, the last one is personal judgment. Now, personal judgment plays here a very important role in the preparation of the final records or maybe the financial statements. So accountant, based on concept conventions, definitely they will prepare the final accounts, but sometimes their own judgment will play a very important role. When they deal with certain elements, so some kind of personal judgment are very important. For example, depreciation on fixed assets. So which method they have to follow, whether straight line method or written down value method. So what about the rate of depreciation, or what about the life of the asset? So all these are based on maybe the personal judgment. Next, the valuation of inventory, whether we can go for the accounting standard 2 or the LIFO or FIFO method. Again, the writing of the intangible assets, like for example, writing of preliminary expenses and all. So how many years we can take for writing of, and how much amount or percentage we can fix every year. Next, with respect to the provisions. So all these are demand certain personal judgment in the preparation of the financial statements. So finally, to conclude this session, basically we will started the discussion of the reason for the preparation of financial statements. So the 1930 event, the Great Depression in the US, demanded the companies to prepare and present the financial statement. And the meaning and definition of financial statement. So financial statement are nothing but a concise and understandable manner of presentation of the financial status or performance of the company to all the stakeholders. So stakeholders maybe ಅಲ್ಲಿ ಶೇರ್ ಹೋಲ್ಡರ್ಸ್ ಆಗಿರ್ಬೋದು, ಮ್ಯಾನೇಜ್ಮೆಂಟ್ ಆಗಿರ್ಬೋದು, ಕ್ರೆಡಿಟರ್ಸ್ ಆಗಿರ್ಬೋದು, ಗವರ್ಮೆಂಟ್ ಆಗಿರ್ಬೋದು, ಅಥವಾ ಇನ್ಕಮ್ ಟ್ಯಾಕ್ಸ್ ಅಥಾರಿಟೀಸ್ ಆಗಿರ್ಬೋದು, ಸ್ಟಾಕ್ ಎಕ್ಸ್ಚೇಂಜ್ ಆಗಿರ್ಬೋದು, So all the stakeholders, they use that financial statements. Next, the types of financial statement. Four broad types we discussed: income statement, position statement, that is the balance sheet. Next, we discussed about statement of cash flow. Under three heads, the cash flow statement will be prepared: operating, investing, and financing activities. And the last one is statement of changes in equity. And the last area we covered in this session is nature of financial statements. So how the financial statements are prepared, maybe based on the recorded facts, where the data we are drawing from the accounting records, maybe the trading account, profit and loss account, or maybe the accounting cycle will helpful here, and it is based on historical data. And the second point is with respect to based on accounting conventions and principles and postulate, or maybe certain assumptions we are making in the preparation of financial statements, like we discussed here. And finally, the personal judgment in the preparation of the financial statements. Thank you.